Most people are misreading XRP right now. A viral 114 trillion DTCC claim is wrong, but the institutional infrastructure developing underneath that story is very real. In the next few minutes, we'll separate the confirmed DTCC developments from the XRP speculation and show why Ripple Prime, tokenized treasuries, and the repo market may matter far more than the viral headline. The 114 trillion figure isn't fake. That's what makes this story so easy to understand. DTCC really does hold securities worth more than $114 trillion. But that does not mean DTCC has announced that $114 trillion will be tokenized and moved on-chain within 50 days. The actual development is more specific and potentially more consequential. DTCC is moving its tokenization infrastructure toward production, with an October launch planned for a defined group of assets, including Russell 1000 equities, major index ETFs, and U.S. Treasuries. And here's the part most viral videos are missing. DTCC has already processed production transactions involving tokenized securities. So the question isn't whether tokenization is coming. It's already entering the market. The question is which institutions, blockchains, and settlement systems will connect to that new infrastructure, and where does Ripple fit? If you want the satellite perspective, ladies and gentlemen, on XRP and crypto, and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel very much. What DTCC is really launching. Now, this is what most people miss. The thing launching in October isn't simply Composer X. Composer X is the broader DTCC technology suite. The actual initiative is the DTC tokenization service. DTCC describes Composer X as an end-to-end platform for managing digital assets across their life cycle, including token creation, issuance, servicing, reporting, and settlement. And in December 2025, the SEC's staff issued a no-action letter allowing DTC to offer a defined tokenization service for DTC, participants and their clients on pre-approved blockchains. The authorization applies to a defined group of liquid securities, Russell 1000 constituents, major index ETFs, U.S. Treasury bills, notes, and bonds. Not everything, not all 114 trillion. A defined starting universe. And there's another detail here that's incredibly important. The tokenized representation is designed to maintain the same entitlements, investor protections, and ownership rights as a traditional security. So in other words, this isn't DTCC saying, forget Wall Street, put everything on a public blockchain. No, it's almost the opposite. It's saying, let's bring blockchain technology into institutional market infrastructure while preserving the protections institutions already rely on. That is a much bigger structural development than a viral number. July changed the story. But here's where it gets interesting, because we're not just talking about a future roadmap anymore. On July 15th, 2026, DTCC announced that it had successfully converted DTC-held securities into tokens and used those token assets in real production trades. That's massive. More than 30 firms participated, and the transactions weren't theoretical. DTCC says that July production activity included collateral, pledges, securities, lending, U.S. Treasury, and repo delivery versus payment transactions, equity DVP transactions, delivery versus delivery transactions, token transfers, and CCP margin workflows. Think about what that means, ladies and gentlemen. Let that think in. The market wasn't merely testing whether you can create a token representing security. It was testing whether that token could actually participate in institutional financial workflows. That is a completely different milestone. The technology wasn't confined to one blockchain. DTCC says the July activity used LFDTs, BISU as a private network, and Canton as a public network. That's part of a broader multi-chain strategy. And DTCC has since announced Stellar as another public blockchain connection for the tokenization service. So the real story isn't one blockchain replacing Wall Street. The story is interoperability, multiple networks, existing custody, regulated participants, tokenized representations, and traditional market infrastructure sitting in the middle. I want you to understand this. This is a very useful historical lesson here. In 1971, President Richard Nixon suspended the dollar's convertibility into gold for foreign governments. The immediate headlines were dramatic, but the deeper transformation took years. The monetary system didn't simply flip from one system to another overnight. No. Institutions adapted, contracts adapted, markets adapted, and eventually an entire monetary architecture evolved around a new reality. That's the first historical lesson. Financial infrastructure often changes in layers, not in one dramatic switch. And that's exactly why the 114 trillion claim is so misleading. A system doesn't need to move every asset on day one for the infrastructure underneath it to change fundamentally. That is very important. Let that sink in. Write that down. Sometimes the most important moment is simply when the new architecture becomes officially usable. Here's the working group. Now let's get to Ripple, because this is where the story becomes much more interesting. In May, DTCC said its industry working group included more than 50 firms. The list is not obscure. BlackRock, Bank of America, Citigroup, Goldman Sachs, JP Morgan, Morgan Stanley, NASDAQ, NYSE, State Street, UBS, Wells Fargo, and importantly, Ripple Prime. Fireblocks is also listed. That it's confirmed by DTCC itself. And this matters because Ripple Prime isn't simply an XRP community project. Ripple Prime is the institutional prime brokerage business Ripple obtained through its acquisition of Hidden Road. So when Ripple Prime appears inside a DTCC industry working group, that is a legitimate institutional connection. But we need to be precise. Participation in a working group does not mean DTCC has selected XRP as its settlement asset. It does not mean Ripple Prime has been given exclusive access. It does not mean the DTCC tokenization service runs on the XRP ledger. This is very important. And it certainly doesn't mean DTCC has announced XRP as its official tokenization currency. Those claims go beyond the evidence. The confirmed fact is simpler. Ripple Prime is participating in the industry process, helping shape the tokenization infrastructure. And that alone is significant. Here's three connections claim. We need to clean up another viral talking point, ladies and gentlemen. You've probably heard that XRP has three confirmed entry points into DTCC's tokenization architecture. Ripple Prime, Fireblocks, Securitize. There's a problem. DTCC's official May 2026 working group announcement confirms Ripple Prime and Fireblocks. But Securitize is not on the published list. Securitize absolutely has relationships with the broader digital asset ecosystem and has worked with the XRP ledger. But that is not the same thing as being a confirmed participant in this specific DTCC working group. And that is exactly where financial content needs discipline. A connection between two companies can be real without creating a direct connection between their entire infrastructures. That's the difference between company A works with company B and company A's blockchain is now integrated into company and institution C. Those are completely different claims, ladies and gentlemen. Prices reacting, systems evolving. And if you're trying to understand the future, that distinction matters. Think about the railroad. A railroad doesn't become valuable simply because one city builds a station. The real transformation comes when the stations, tracks, switches, freight deposits, and standards begin working together. That's the analogy for tokenized finance. The blockchain is the track. The token is the freight container. But DTCC, banks, custodians, broker-dealers, and settlement systems regulators are the stations, switches, and operating rules. A fast blockchain sitting alone doesn't transform Wall Street. No. Integration does, and that's why the DTCC story reserves so much attention, even if XRP, the anointed one, never becomes a primary settlement asset. Because the infrastructure itself is moving towards a world where securities can exist simultaneously in traditional and distributed ledger environments. That is the structural change. Securance, the claim that needs correcting. Now let's deal with another important detail. You may hear that the DTCC acquired Securitize. That is incorrect. DTCC acquired Securrency in 2023. The company became part of DTCC Digital Assets, and the technology later became the foundation for Composer X. Securitize is a different company. That distinction matters because some viral analysts take an old description of Securrency technology and connect it directly to today's DTCC infrastructure. Historically, Securrency describes its technology as being capable of operating across multiple distributed ledgers, including Ethereum, Stellar, Ripple, and EOS. That's interesting, but it should not be presented as proof that today's DTCC tokenization service has officially selected XRPL. Those are two very different levels of evidence. The historical C-currency technology demonstrates interoperability capabilities. Today's DTCC service has officially announced specific networks and a broader multi-chain strategy. And that is where the evidence stops for now. Ripple's biggest strategy. But here's where the Ripple story becomes much more interesting than a simple DTCC connection. Ripple isn't just building one blockchain application. It has been assembling an institutional financial stack, Ripple Prime, Ripple Custody, Ripple Treasury, RLUSD, an infrastructure designed to connect traditional financial assets with digital settlement. The strategy is important because institutions don't necessarily need another speculative crypto product. They need infrastructure. They need custody. They need liquidity. They need collateral management. They need compliance. They need settlement. And they need the ability to operate across multiple markets without rebuilding their entire financial stack. That is where the XRP ledger can potentially matter. Not because every dollar in global finance must suddenly use XRP, but because a blockchain that can handle tokenized assets, stablecoins, custody workflows, and institutional settlement can become part of a much larger financial machine. That's a far more defensible thesis, ladies and gentlemen. Repo, the $8 trillion market. And now we arrive at one of the most important pieces of this entire story. Repo. A repurchase agreement sounds complicated. The basic idea is simple. One institution has securities, often treasuries. Another institution provides cash. The securities serve as collateral. Later, the transactions reverse with interest. It's one of the fundamental mechanisms of modern financial liquidity. And the scale is enormous. The Federal Reserve Bank of New York's Treasury Market Practice Group said in 2025 that the U.S. Treasury repo market had more than $8 trillion in average daily transaction value. That is why tokenized settlement becomes so interesting, because these aren't assets that move once and sit down somewhere. Collateral moves, it gets pledged, released, substituted, financed, repriced, and reused. The opportunity isn't merely tokenizing a treasury. The opportunity is digitizing the movement around the treasury. Ripple's repo development. This is where a recent development deserves careful attention. A Ripple product manager was reported as saying that Ripple is building repo settlement on the XRP ledger with Ripple custody identified as the immediate custody for an on-chain code signing system. That's massive, and it's very interesting and an engineering signal. But let's be very precise. This does not mean $8 trillion of treasury repo is moving onto XRPL. It doesn't mean Ripple has captured 5% of the repo market. And it doesn't mean XRP will automatically become the collateral or settlement asset for every transaction. Those are scenarios, not facts. What is interesting is the engineering problem Ripple appears to be targeting. How do you allow multiple institutional parties to authorize a transaction? How do you make the exchange of collateral and cash atomic? How do you make sure one side doesn't settle without the other? And how do you do that while institutions maintain custody, controls, and regulatory permissions? That's a real financial infrastructure problem. Let's talk about XRPL and atomic settlement. This is where XRPL's technical architecture becomes relevant. The XRP ledger has been developing transaction functionality that can support more complex atomic workflows. The idea is straightforward. Instead of one transaction completing and the other side trusting that a second transaction will eventually happen, the desired outcome is for the linked actions to execute as one coordinated operation. For repo, that's powerful in theory. Collateral moves, cash moves. Transaction either completes according to the agreed conditions or it doesn't. That doesn't eliminate legal agreements. It doesn't eliminate custodians. It doesn't eliminate regulators. And it doesn't eliminate counterparty risk. But it can potentially reduce operational friction and settlement risk. And that's the key distinction. Blockchain isn't magic. It's a new execution system. The second historical example is 2008. During the financial crisis, the world learned that plumbing mattered. People watched banks, they watched mortgages, they watched credit markets. But beneath all of that was a massive network of collateral, short-term funding, and counterparty relationships. When confidence disappeared, liquidity could disappear with it. Repo markets were part of that broader funding architecture. The lesson wasn't that financial markets needed more exciting assets. The lesson was that settlement, collateral, and liquidity infrastructure can become systematic issues. That is why today's experiments with tokenized collateral deserve attention. Not because blockchain automatically makes markets safe, but because improving the movement and visibility of collateral could become strategically important. Here's another analogy that I love, and it's very important. Imagine the shipping industry before standardized containers. Goods could move across ships, trains, and trucks, but every transfer required handling, and standardized containers changed the system. The container didn't replace the ship. It didn't replace the port. It didn't replace the railroad. It standardized the object moving between them. Tokenization could play a similar role in finance. A security remains a security. A treasury remains a treasury. A fund remains a fund. But the representation becomes programmable and interoperable across digital infrastructure. And suddenly collateral can potentially move between financial applications without every participant building an entirely separate process. That's the real promise. Not everything becomes crypto. Everything becomes more machine readable, programmable, and transferable. What is actually confirmed here, ladies and gentlemen? So let's separate the confirmed facts from the speculation. Confirmed. DTCC's DTC custody network is valued at more than 114 trillion. Confirmed. DTCC has received regulatory authorization for a defined tokenization service. Confirmed. The initial eligible assets include Russell 1000 equities, major index ETFs, and major treasuries. Confirmed. DTCC planned limited production activity for July and a broader service launch for October 2026. Confirmed. That July production activity actually happened. Confirmed. DTCC says tokenized securities were used in real production workflows, including Treasury Repo, DVP. Confirmed. Ripple Prime is a member of the DTCC industry working group. Confirmed. Fireblocks is also a member. Confirmed. DTCC is pursuing a multi-chain strategy rather than announcing a single blockchain winner. Confirmed. The U.S. Treasury Repo market averages more than 8 trillion in daily transaction volume. And separately, Ripple is building institutional infrastructure around custody, prime brokerage, treasury management, stablecoins. Those are the facts. Now the speculation that all 114 trillion will be tokenized in 50 days. Not confirmed. That XRP is the official settlement asset for DTCC. Not confirmed. That DTCC has announced direct XRP ledger access for tokenization service. Not confirmed. That Securitize is a DTCC working participant. Not supported by the official May participant list. That 5% of the Treasury repo will move through XRPL. That's a scenario, potentially interesting, but still a scenario. What could matter most for XRP? Now, this is what I think investors should actually be watching. Not the 114 trillion headline. Watch the connections. Watch where the Ripple Prime moves deeper into institutional post-trade workflows. Watch where the Ripple custodians supports more tokenized collateral use cases. Watch where the RLUSD becomes more deeply integrated institutional settlement. Watch whether XRPL's transaction capabilities are adopted for actual financial workflows. Watch whether repo experiments become commercial products. Watch where the public blockchain DTCC connects next. And more importantly, watch whether these systems move from pilots to recurring production activity, because there is a massive difference between a proof of concept and a business process. The July DTCC event matters because it crossed that line. Production is where the story gets real. Here's the bigger macro story, ladies and gentlemen. Zoom out with me. This isn't really an XRP story. It isn't really a DTCC story. It's a market structure story. For decades, financial assets have lived inside fragmented databases. Custodians have one system. Broker-dealers have another. Exchanges have another. Clearinghouses have another. Settlement systems have another. Tokenization offers a way to create shared digital representation that can communicate across those environments. But institutions aren't going to throw away the old infrastructure overnight. They're going to connect the new infrastructure to the old infrastructure. That's why DTCC's approach is so important. That's why the working group matters. That's why multi-chain matters. And that's why Ripple's strategy matters even if XRP doesn't become the universal settlement token. People on social media imagine the transition is likely to be incremental, controlled, regulated, and extremely large. Here's the real takeaway, and this is my conclusion. The viral 114 trillion 50-day claim is the wrong headline. The 114 trillion number is real, but it represents assets under DTC custody, not an October promise to tokenize everything. The October DTC tokenization service is real. The July production milestone is real. The Russell 1000, major ETFs, and U.S. Treasuries are part of the authorized initial universe. Ripple Prime really is inside the DTCC industry working group. Fireblocks really is there too. but there is no confirmed DTCC announcement saying XRP Ledger is the official blockchain behind the service. And there's no confirmed announcement that 114 trillion is moving onto XRPL. The more interesting story is what happens next. Because once regulated markets infrastructure begins accepting tokenized securities as a legitimate operating format, the question changes. It is no longer will Wall Street tokenize assets. The question becomes, which networks, institutions, and settlement systems will capture the resulting activity? And that's a much harder question. Short-term noise, long-term structure. Prices react and systems evolving. The 114 trillion headline may be wrong, but don't let a bad headline make you miss a genuine structural shift. DTCC is moving tokenization into production. Ripple Prime is sitting inside the institutional conversation. Ripple is already an 8 trillion plus a day market, and Ripple is openly working on institutional infrastructure that can intersect with tokenized collateral and settlement. None of this guarantees XRP price appreciation. None of it guarantees XRPL becomes a dominant settlement network, but it does mean the institutional blockchain story is moving from theory towards infrastructure. And October is now a date worth watching. If you want the next breakdown when DTCC releases another major update, subscribe to the channel, turn on notifications, because in this market, the biggest opportunity may not be hiding in the viral headline. It may be hiding in the plumbing underneath it. Hope everyone's having a blessed Friday, everybody. What a week. I want to welcome all the members of the Patreon, the Crypto Public Desk Monthly. I want to welcome all the new members of the membership channel. Remember, one solid tip from the pits will pay for your entire year subscription. If you're looking for the deeper macro research, come and join over 680 active traders and investors. It doesn't matter where you are in your journey. If you're a seasoned veteran or you're just starting, come and join us, ladies and gentlemen. I want to go over one thing that I have been spending all day on the phones talking about, and this is very, very important, and nothing what I'm about to say is financial advice. We have room to go higher, ladies and gentlemen. There's signals telling us that things are going to go higher much now. We are now on the flip side of the Harry Houdini freak show. The yields are going to have to come down, but I want to focus on this. See, gold is sending a message right now, and Goldman Sachs, they're putting out some very interesting numbers behind this. Goldman Sachs is seeing steady buying from China and Western macro investors. And that buying actually accelerated after Treasury buyback announcement. This is massive, and I think this is really important. It's not financial advice. Remember, we're just talking about Treasury, okay? The buyback may not be a massive liquidity event by itself, but it's a signal that Treasury is becoming more active in trying to stabilize the long end. And according to Goldman, the more lasting implication may not even be for bonds. It could be for the dollar and gold. And in this market, we're watching money now flow into other assets. That is why crypto is going to benefit. XRP, ICP, gold. It's very important now, ladies and gentlemen. Think about this. See, Treasury becomes more proactive. The dollar comes under pressure, and gold becomes one of the natural release valves, okay? And this isn't just theoretical interest that Goldman and other banks are seeing. They're seeing significant inflows from investors. They're buying 3 to 6 month gold structures and outright exposure. They're targeting 4,800 to 5,500 an ounce. That's what Goldman Sachs and others are saying. So they're running 6 out of 10 length. They're long volatility, they're long skewed, and they're long delta. So what that means in English, taking the PhD out of PhD, they're not looking at gold and saying the trade is getting too crowded. Let's get out. They're saying the exact opposite. We're comfortable staying long, ladies and gentlemen. And Goldman's been right when it comes to gold. Here's where it gets even more interesting as far as we're concerned. See, China is buying. They're eating the sushi up. They're eating it. Western macro funds are buying. Central banks are gradually coming back in. And according to Goldman, Chinese gold imports are up an incredible 80% year over year, with more than 444 metric tons imported so far this year. Goes back with our thesis, ladies and gentlemen, what I'm talking about, them, the bricks, the unit, gold moving physically over there. It's happening. This is important. Write this down. It's so enormous. I don't even know how to explain this. So even though July imports fell, okay, the decline was largely because of lower free trade zone imports, while customers cleared imports remained relatively stable. Ladies and gentlemen, the physical demand story hasn't even disappeared. And when you get central banks, it's massive. According to Goldman, they're tracking 55 reserve managers with the exception of Russia. They're seeing essentially nobody liquidating. The UK to China export data uses as a proxy for POC demand. That's a very, very important thing. See, they look at the UK to China data and the PBOC, the demand averaged for 37 metric tons per month in the second quarter versus just 50 metric tons per month in 2025. That's so huge, and that's a massive change. And if you look at Turkey, they're slowly buying back the gold they sold during the early stages of the conflict. So there you got China, you got central banks, you got Western macro investors, lions and tigers and bears. Oh my. And then you got the technical money starting to come back. You got CTAs and lemmings. They're getting back in. Everybody's rushing in now because nobody wants to buy on the down. You do well buying in the blood, buying in the red. You don't buy in the green, ladies and gentlemen. That's chasing the trade. You get chopped up like sushi here, okay? That's what happens here. But I want you to pay attention to this. See, according to Goldman, positioning isn't stretched yet. And that's important because when you got strong physical demand, central bank accumulation, macro buying, positive momentum, and position that hasn't become excessive, you don't necessarily have the classic setup for a top. You potentially have the ingredients for another leg higher. And according to Goldman, they see our demand targeting 4,800 to 5,500 gold. So when you put everything together, we've been talking about together, the picture gets pretty fascinating. Treasuries being more interventionist. The long end is under pressure. The dollar potentially becomes a release valve. The long end of the yield curve's under pressure. Ladies and gentlemen, the markets and banks smell blood. They're going to get aggressive. They're going to go for it. So China's accumulating physical gold. They're eating it up. Central banks are re-engaging. Macro funds are buying. And you have to understand something. Everybody in the street are turning back into buyers now. So demand is surging, and Goldman's looking 4,800 to 5,500. I'm not saying gold has to go straight there. Markets don't move in straight lines. But this is why I think you need to stop looking at gold as simply an inflation hedge. Gold is increasingly becoming a monetary hedge, a fiscal hedge, a currency hedge, and hedge against the possibility that policymakers eventually have to become much more aggressive with liquidity, ladies and gentlemen. And if you look at all of this together, see, central banks don't buy silver. They don't. So when gold starts to get very expensive, they're not going to buy silver. Nothing I just said is financial advice. It's just my own opinion and it retains any capacity. This video is for education on intent purposes only. Always consult a licensed financial advisor. Never invest a single dollar, ever, from watching a YouTube video. Ladies and gentlemen, being financial mercenaries, when it's time to set sail and hoist the mainsail, we allow the winds of volatility to push us where we're going. Nobody wanted to buy when we told people to buy XRP at $1. On the Patreon, a lot of people, they were concerned. Maybe it'll go lower. Look where it is now. Look at the moves it made now. In this video, you can see and why I put gold at the end of this. I want you to understand something. The maneuvers with the DTCC, as far as we're concerned, on the west side of the tranche is in response to China's and the BRICS east side of the tranche making moves, trying to copy the Western financial system, commodities, everything. Been in this game since I'm 15 years old, working for exchanges, working with some of the powers that be in this game. And you learn a lot of things from a lot of people. This is Act 2 of the Harry Houdini Freak Show. Pay attention here. Pay attention here. We will hear this wind of volatility until Congress comes back. That's when you could see someone trying to throw cold water on this right now. But if this move to force Congress to vote on the clarity fails, they'll ramrod down regulations. And ask yourself this question: would the powers that be rather POTUS in this administration just write rules, or would they rather have rules that they pass through Congress? Let me hear in your comments in this comment section of this YouTube, because I have my own opinions. I'm going to go over on our Sunday Zoom call about what I think and why. I love you all, ladies and gentlemen. I'm going to see you on the front lines. But XRP, ICP, HBAR, XLM all the way. Because again, the times are changing, ladies and gentlemen. I love you all. I'm going to see you on the front lines.